Okay, very good. Let's switch gear a little bit and talk about your capital raising.
Sure.
Yeah, share with us what are some of the, I guess let's take a step back. Looking at the opportunities that exist this year, as you mentioned earlier, a lot of distressed properties. How many units are you looking to buy up this year, or is there a goal of units or square foot that you're looking?
Yeah, we don't actually have that. We've gotten into pickles in the past when we said, hey, we want to buy like 40 units, or we want to buy this year, we want to buy $40 million worth of storage. What we've learned is that we just stretch the facility to make it work. And when you do
Mm,
that, it eventually stretches back, and you're like, man, I wish I wouldn't have bought that one. But I reached my goal. No one really, I don't care about that. No one really should care about that. We should just focus on buying really good assets. And by buying really good assets, the only goal that matters is you get great cash flow and you also get great wealth accumulation. So we don't really have any metrics in that regard, but we look at anything that hits our desk. We want to make sure that we're covering the market. We want to look, if there's a deal that's for sale, we want to look at it and see if it fits our criteria. And if it does, then we'll pursue it.
yeah, I see. Okay, got it. In terms of capital raising, share with us some of the best ways that you have found to attract capital. And then also, have you, I assume that self-storage is popular enough nowadays that you don't have to do as much education to the investors as you probably as in the past, but give us some of the things that have been working well for you on the capital raising side.
Yeah, I think the easiest way to raise money is with your existing network and then your secondary network. So let's say, Tim, you give me 100K on the one of these deals. You tell your buddy, he goes, oh, yeah, yeah, I want in on that deal. I think that's the best thing. When money is liquid, when you can raise money easily because there's a lot of money in the market and everything is liquid and you can refinance your properties, stuff like that. Money is pretty easy to raise from a network
Yeah.
only standpoint. Outside of that, we do lead in outreach, we do cold email outreach, we do cold calls to accredited investors. But ultimately, the easiest investors are only going to invest with you if they know, they like, and they trust you. So I've had articles written about me that are easily searchable. Podcasts are a good way to get your name and your reputation out there. I post blogs on LinkedIn and then I reach out to accredited investors on LinkedIn to see if they're interested in chatting about real estate. A lot of those are just really slow, nurturing campaigns. But with that said, we want really good limited partners that understand us, that know where we're going. And we've raised capital and let people into deals. And it's amazing if there's ever that I probably shouldn't have let in. Those people are always the ones that send the emails. They're the ones that are always complaining about things not going exactly the way the pro forma said. You're like, well, yeah, it's 2025. We're in a downturn, that sort of thing. It's just going to be, we're going to have issues there. But ultimately, to go back to your question, it's almost like a full-time job. Raising capital, you're really not in the real estate business. You're in the raising capital business. And until you are big enough to hire someone and all they do is raise capital for you, you're always going to be in the raising capital business. And a real estate deal is pretty easy to find, especially a commercial real estate deal that has a good amount of upside. If you spend 2 hours a day looking at deals, then you're probably going to find one within a good amount of time.
I see. Okay. And yeah, in terms of when you're reaching out on LinkedIn to accredited investors, who exactly are you looking for? How do you know that they're accredited? Is there a certain avatar or
Sure.
they call it, yeah, ideal prospect that you go after?
Yeah, we look at their jobs and who they work for. So a C-suite level executive at Apple makes more than 200 grand and has a net worth of $1 million. Doctors typically have that as well. Attorneys, business owners, other real estate investors. So we're basically working backwards and going, okay, because you can't do like income filtering or whatever
Hmm.
on LinkedIn, but you can filter on location, job, business that they work for, and that's what we do. And it's not 100% perfect. Sometimes we reach out to someone who's clearly not an accredited investor.
Like the first filter that you go, do you try to find as many of the investors as you can that are close to the assets that you have, or how do you, because if we're talking about C-suite people that work at Apple. Like that could be a
Yeah.
really big list. How do you target down?
We don't really want to. We like if they for Apple, they make more than 200 grand. They probably have some really nice stock options and might want an alternative investment strategy, and so we offer that.
I see. Okay. I was at a mastermind in Austin this past week, and one of the gentlemen there shared about he does something similar to what you're talking about, going after people that works at big company, but he specifically look for ones that has a recent job change. Eh,
401k rollover.
Exactly. Yep. Yeah.
That's actually real
Uh,
smart. I've not thought
yeah.
about that. So
Yeah, I mean, I've gotten to learn from quite a bit of people that are very successful raising money on LinkedIn, and it's very interesting how like each person approached LinkedIn, and so I'm always curious about that. You mentioned even email outreach on LinkedIn. I get that a lot of people do that, but you're talking about email, cold calls. How do you go about doing that, and who are you targeting for those?
sure, I'll just take the first one, emails. Same thing. We've got several. If I were to get into HubSpot and send 20,000 emails to my network, at 5% of them will get it. The rest of them will go to spam. So it's really inefficient, right? And so we've hired a company that knows how to get that basically transverses that will take all of those emails and we'll get a 95% inbox hit.
Oh
At
wow.
least that's what they're selling us on it. But yeah, you'll get a 95% hit on, or everything. 95% of those emails that are email will go into their inbox as opposed to going to spam.
So are these really like cold emails or the email list that you have that somewhat at least know you or know of you?
These are cold emails that we get through like a be a great question for my marketing manager. But the way I understand it is they're cold emails that we're getting from like another source, and we're pulling those
I
into this
see.
other software.
Gotcha. I understand now. Okay. And do you happen to know what the first message that goes to them sound like?
I hire people to do that for me.
Okay. Yeah. I'm very curious. Cold email is a really hard one to crack, especially for investors, because it's, yeah, like any of us, like when's the last time we open a cold email or at least respond to a cold email? Okay, very cool. And then cold calling works the same way. It's the same list with phone numbers, and then
Yeah, the cold
you have
calling is
people.
different. The goal with cold calling is that they set up an appointment with me or my investor relations person. And so it's actually AI that cold calls, that it sounds just like me or it sounds a Texan. And they set appointments and then we follow up with them. As you would imagine, it's a pretty low converting marketing channel, but it's getting us appointments, it's getting people into our HubSpot, it's getting into our CRM for us to reach out and nurture that lead in the future. And so
That is interesting. I'm surprised that even worked. I get it's low converting, but I'm surprised it even works. That's amazing. When we're dealing with sellers, for example, homeowners, sellers, I can see that for that audience it works, but for a more sophisticated investor type audience, I'm really surprised it works. So kudos to you to be able to crack that code. Yeah, that's awesome.
And I'd say money, I mentioned in 2021, money was the easiest thing to raise.
Yeah.
Everybody has cash. Now everyone is dry. There's a lot of dry, like people have lost their shirts on their 401k, or maybe they were in other syndications, real estate syndications that went belly up. I know a lot of guys, most of my friends who are sponsors have at least one project that did not go well and that there was some money lost on it. There's a lot less capital to go out and find. And so our hope is by doing these marketing channels, we're actually finding the capital that's there. And so we want to hit the emails, we want to hit the phones, we want to just as much as possible. We want to hit your LinkedIn. We'll probably eventually figure out how to do text legally. We're always trying to figure out how to get the little bit of capital that's out there to come to us as opposed to anyone else.
Have you looked into targeting the bigger check writers, the smaller family offices, or even RIA type of people?
Maybe I've just talked to the wrong RIAs. I was disappointed in every meeting I've had with an RIA. They're basically financial advisors with a little bit more freedom, but they are still very much careful on non-traditional asset strategies. Small family office, that's on our to-do list and figure that out. I have a huge list of family office people and family offices and like other high-end institutional hedge funds, and we just haven't cracked it. You call those people and they don't take your phone call. There's got to be a different way, and we're still figuring that out. Maybe y'all have figured that out, but we don't. I did have one hedge fund offer some terms for us, but it was like I had to come up with 10% co-invest. They weren't going to pay me any fees, and I was like, man, I feel like I'm working for these people
Yeah.
and not offering them a solution for their investment.
Yeah. What's the you like whenever you buying an asset, what's the typical purchase price, like your deal size?
For storage, the bigger the deal for syndicators, you get paid a 3 to 5% fee when you structure these. So if you do a $2 million deal, you're getting paid 60 grand. But you could do a $6 million deal and make 180 grand. 180 grand goes a lot further paying employees and paying yourself than 60. And it's the
Right.
same exact amount of work. With that said, I think the cheapest one we bought was 2 million, and then we bought a 6.4 million. Ultimately, trying to increase that higher than that in the storage industry, you start dealing with those REITs who don't need to make a 7.5 cap the first year. They can make a 5 cap because they're borrowing money at 5.5 or whatever, and they're a huge company and they can just throw money at it, knowing that eventually the market will turn around and they'll be in a great position with a great location. But yeah, typically 2 to 6 million. We're starting to get back into houses. Those are a lot cheaper. And so we're just trying to attack the market however we can. It's kind of, as you guys know, it's a really weird market right now.
You're trying to get back into houses. I'm surprised to hear that. So share with us about that. What's your thought process on that?
As mentioned before, capital markets are very constrained. And you used to, for a storage facility, you could leverage that thing up 80 to 90% because you're getting a 4% loan. You could pay, that's the old man who's selling it to you. You could pay him a 5 cap on it or a 4 cap and still make money. Now I'm borrowing money at 7.5, 8% on a 25-year. And ultimately, you got to put 50% down. So if you're 10% down to your investors was going to give them a 2.25x return, and now you have to raise 4x more. Mathematically, that's not, you're going to have to raise 4 times more
Mm,
capital, and your return to your investors is going to be less than what it used to be because you're not leveraged as much. And so we're not looking at going into houses the way we did before. It's more of we're looking at getting into some houses and waiting the storm. And then we're still very much looking at storage facilities. But what we don't want to do, and I've already mentioned it, we don't want to buy a storage facility to get a fee because we need the money to operate. And then be like 6 months later, be like, oh, this thing didn't work.
mm,
A bunch of people are upset at us. And so the house thing is just, we know how to get them financed. We know how to turn them around, and we know how to make a little bit of money to keep the ball rolling a little bit. I
I
would say like
see.
right now we're looking at house, either lending hard money, buying houses, lending hard money, doing land entitlement, moving, pivoting a little bit to where the market demand is. I've never been like a loyalist when it comes to assets. I just go wherever the return is. And so that
Mm.
means I've had to relearn a lot of these things, or I've had to learn how to make money in land entitlement or hard money lending, that sort of thing.